When I wrote my latest post, the portfolio was up an incredible 18% year to date. 1 week later, we're pushing almost 20%. I could do no wrong? Wait, this is exactly when complacency creeps in. Check out this notebook LM breakdown of the audit I just ran on my blueprint.
Welcome to The Explainer. Today, we're diving into a really fascinating tactical guide on how to audit your long-term financial plan. But, we're not talking about what to do when the market is crashing. Oh no, we're talking about what to do when things seem to be going almost too well. This is essentially a tactical playbook for those moments when you feel like you just can't lose. We're going to make sure that your massive wins don't quietly set you up for a catastrophic fall down the line. So let's dive right into this.
18%. That is an 18% year-to-date return, and it was achieved on the back of 3 consecutive years of above 15% returns. To put that into perspective, outperforming the historical market average by that kind of margin for 3 straight years, that's incredibly rare. Honestly, it's like catching lightning in a bottle 3 times in a row. Now, if you're managing a portfolio and you hit these numbers year over year, you're going to feel pretty invincible. It's an unbelievable winning streak. But hitting an 18% return like this is exactly when the alarm bells need to start ringing.
And that brings us to the real danger lurking behind a massive winning streak: complacency. The source material frames this perfectly. You see, you kind of can't help feeling invincible because it's quite literally how the human brain is wired. I mean, after you've worked hard and achieved success for so long, your biology actively seeks out comfort. It's a really powerful biological trick. You start thinking you can do no wrong, but actually, scratch that, it's worse. You just stop thinking about risk altogether. And that dangerous state of relaxation is exactly when you are most vulnerable.
So how do we actually fight our own biology? Well, the solution is a structured, repeatable portfolio audit. We literally have to use our frontal lobe, our logic and reasoning center, to deliberately overrule those natural, euphoric feelings bubbling up from our reptilian brain. We're going to walk through a rigorous 3-check diagnostic audit that you can apply to your very own holdings. It's all about catching that complacency before it takes root. Here's the roadmap for this explainer. We'll start with the complacency trap, then hit our 3 checks, evaluating the cash buffer, testing asset allocation, and reviewing sector exposure, before wrapping up with the final verdict. All right, segment 1, the complacency trap and the danger of winning. That 18% return we talked about, it wasn't just blind luck. It was the result of some highly deliberate strategic moves. The investor successfully pivoted from Singapore real estate trusts, S-REITs, over to Singapore banks right before historic interest rate hikes hit. They held on to compounders like iFast and Arista Networks, even through some really wild price volatility. Plus, they snagged Alphabet on the cheap when the market was basically panicking over AI disrupting search. Oh, and they aggressively rode the semiconductor upcycle long before the broader market even caught on. When you make a string of brilliant pinpoint calls like this, well, success naturally breeds complacency. You start to trust your gut just a little too much.
Which brings us to the first step of our tactical playbook. Check 1. Auditing your short-term defense, specifically your cash buffer.
So in this specific audit, the investor noted they're about 3 years away from gaining access to their CPF OA, retirement savings. And that is a major liquidity milestone. They had technically secured enough cash to bridge that 3-year gap. But, you guessed it, complacency crept in. They just couldn't resist using their defensive cash to go on the offensive. They bought up more positions in high-growth momentum plays. We're talking Food Empire, Tractor Supply, Ulta Beauty, and Viva Systems. Breaking your own rules to chase high-growth stocks, that is the absolute textbook definition of complacency. And suddenly, their defensive cash cushion was looking a tad short.
The absolutely crucial point here is knowing when to pivot. Recognizing this slip in discipline means it is time to immediately lock down the defense. The source actually uses a brilliant football metaphor here. They warn against blowing a comfortable lead in the final stretch, kind of like how the Egyptian national team threw away a 2-goal lead and lost in stoppage time. Ouch. The market, much like a football pitch, is never completely fair. Institutional giants always have deep pockets and just sheer capital weight on their side. As retail investors, we don't have that luxury. We have to survive on our agility. We can't control the wind, right? But we absolutely can adjust our sails. And when you realize your cash buffer is coming up short, you must adjust your sails and pivot back to cash.
Moving right along to the next diagnostic. Check 2, asset allocation, testing that portfolio weight.
Now, in personal finance, there's this super popular rule of thumb, the 11-age formula. For a 52-year-old investor, this textbook theory suggests you should carry roughly 58% of your net worth in equities, with the rest parked in safer stuff like fixed income and cash. But we have to pit this textbook theory against mathematical reality. In this specific audit, despite a massive run-up in stock prices, the actual portfolio is only holding 51.6% in equities.
When we look at the distribution of total assets, making sure to factor in cash and CPF balances, the math becomes crystal clear. It proves that even with those massive double-digit stock gains we talked about earlier, the investor is sitting comfortably below the textbook equity ceiling. So what does this actually mean? Well, it means there's no structural need to aggressively buy more stocks just to hit a target, and conversely, there's absolutely no need to panic sell to reduce equity exposure.
But here is where we get some fantastic contrarian wisdom from the source. These financial rules of thumb, they're just guidance. They are not commandments written in stone. You really have to tailor your allocation to your unique life circumstances. Think about it. If you're 80 years old, the textbook says you should only hold 30% in equities. But what if you already have 10 years of living expenses safely tucked away in a cash buffer? Or what if your capital is specifically earmarked for generational wealth, meaning your time horizon actually resets to your kid's life expectancy? Or what if it's meant for a permanent charity endowment that thrives on long-term compounding? Blindly applying financial shortcuts without zooming out to look at your own massive cash buffers or legacy goals, that might completely steer you off course.
And that brings us to the final step in our diagnostic framework. Check 3, sector exposure and evaluating concentration risk.
You know, when you have a truly massive year, it's really often driven by one specific sector catching fire. In this case, local semiconductor manufacturers. What's kind of startling is that this specific allocation aggressively jumped from about 12% last December to almost a quarter of the entire portfolio today. That kind of rapid change naturally brings a bit of trepidation, right? To manage this without panicking, the investor introduces a brilliant tactical concept, setting a strategic guidepost. Basically, they set a hard ceiling at 30%. If the semiconductor sector crosses 30% of the total portfolio, they'll sit down and reevaluate the need to trim. But until then, they just let their winners ride. Setting a firm guidepost like this is incredibly effective because it completely removes emotional decision-making from the equation during a market frenzy.
So why hold steady with almost 25% of your money tied up in one sector? Well, the investor outlines 3 highly analytical reasons to ride out this concentration risk rather than forcing a premature sale. First up, based on forward guidance, we're basically only in the second inning of the semiconductor cycle. The global boom in AI and chip demand is still ramping up, and supply literally just hasn't caught up with demand yet. Second, portfolio weighting is dynamic. A recent market correction naturally lowered the sector's allocation from 28% down to 24%, with the investor having to lift a finger, which means they automatically rebalanced without triggering capital gains taxes from selling prematurely. And third, these stocks were mostly purchased using CPF funds, meaning even a short-term crash wouldn't impact the investor's day-to-day defensive cash flow. Honestly, this is a masterclass in separating emotional panic from analytical reality.
All right, let's pull all of this together. Section 5, the final verdict. Let's look at the synthesized results. After running the portfolio through the cash buffer check, testing the asset allocation, and evaluating the sector exposure, the verdict is in. There's a slight shift in the portfolio's balance, sure, but the overall foundational structure remains completely solid. Catching this ego-driven drift early is exactly what prevents irreversible financial damage down the road. So, the final verdict? Absolutely no structural fault detected. We are good to go.
But remember, the market will always test your discipline, especially when you are winning. So I want to end this explainer by directly challenging you. Take this tactical playbook and ruthlessly audit your own financial complacency. Your portfolio might be up right now, and you might feel totally invincible today. But if the market turns tomorrow, is your defense truly locked down? Think about it.